Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest on the program today is Adrian Day. He's the chairman and CEO of Adrian Day Asset Management. Adrian, welcome back to the program.
Thank you very much. Nice to be here.
Adrian, you're based in Annapolis, Maryland, which is just a few short miles from my hometown, a little south of that. And I can't imagine that there's too much excitement or investors in the junior resource space. By way of background, how'd you end up running, an asset management company that has some focus on mining?
Gotcha. Well, gold was actually my very first investment many, many years ago, but let's just say I was a young teenager at the time when I first invested in gold. So I've always had an interest in gold. Originally, from the sort of Austrian economic point of view and the hard money point of view, looking at gold as money. So that's how I came to be interested in gold, and then from that, of course, you begin to get interested in gold mining companies. So, I've always had an interest in, entrepreneurs who work hard and, build something, have success. That's a wonderful thing in any kind of business, but, gold being what we're talking about, it happens in gold, and it's a wonderful thing to build something from nothing. So, I'm just interested in that. And, of course, asset management, you can do it anywhere. Annapolis is a nice place to live, so that's where I am.
Absolutely, it is a nice place. Adrian, the price of gold has broken through 1,300 and looks like it could very well stick there. Meanwhile, you have a lot of other commodities like copper, zinc, lead that are breaking out to either 52-week or multi-year highs. What's your feeling like for this fall season in terms of the equities for the mining companies?
Oh, yeah, I would say I'm very bullish. If you're talking just this fall, very bullish. Obviously some of the factors that are driving gold are, some of them overlap with the factors that are driving other commodities, and some of them are totally separate. And I think it's always clear that you understand why something's moving before you invest. But, if you look at this year, I'm not a technician, but if you look at this year, you've seen gold swing up and down 3 times. And each time we've gone to higher, 4 times. Each time we've gone to higher highs and higher lows. That's a very, very bullish pattern. And I think we've just been waiting to break through this 1,300. To me, it's extremely positive, but gold has held well above the 1,300, even though the Korean situation has just eased a little bit in the last couple of days. Obviously Korea firing the missile over Japan was what made gold shoot up above 1,300, but the fact that it's held that and moved even higher is very, very positive in my view. And, fundamentally, the factors that are present today were really present back in January, but less recognized. Clearly monetary policy around the world is easy, and despite the talk about reducing the balance sheet and the talk about tightening, not just by the Fed but by other central banks, the central banks are going to be very, very cautious in tightening. And the truth is they simply can't tighten too quickly, and they can't reduce their balance sheets too quickly. So monetary policy is going to remain easy. And we've seen that in some of the recent sort of cautionary statements from the Fed. So, that's definitely one thing. The dollar was looking very, very toppy at the beginning of the year. And again, I've been a little bit surprised that we haven't had an upward correction. It's fallen this year, obviously, as everybody knows, or I hope everybody knows. But I've been a little bit surprised that we haven't had more of a correction in that decline. So the dollar is looking quite weak to me, and I doubt very much if let's say the Trump administration is going to do much to stop the dollar falling. The dollar, as you know, comes in the orbit of the Treasury Department, not directly under the Fed. So I don't think we're going to see much action there. But I think the other big factor is, when things are going well, when the economy is going well, when the stock market is doing well, and financial assets are doing well, people don't feel the need to own gold. The last few months, increasingly, we've seen concern about the U.S. stock market in particular, as well as some other global markets. But you look at the U.S. stock market selling at valuation levels that are higher than where it has traded 90% of the last century. So I don't think we're in a bubble, because a bubble has specific, defining characteristics. But we are certainly at extreme levels of valuation. And we could talk about whether it's price to revenue or, a lot of different valuation metrics. You can justify some of it by the low interest environment. Obviously, in a low interest environment, you expect dividend yields to be lower. But nonetheless, when you look at all these different valuation metrics and you see that we're at these extreme levels, some levels we haven't seen since the dot-com bubble, then it clearly people are becoming a little bit cautious on the stock market, and some money is moving from stocks into gold. So anyway, all these sort of things. But I think the last thing that's very, very important is that gold and gold stocks in particular, even more so, remain very, very underowned. And that is key, because it means as gold's broken out above 1,300, you're going to start seeing more and more people, retail as well as institutional hedge funds, move into gold. Because at the beginning of this year, most institutions, most hedge funds were completely out of gold. The last few weeks, a few have moved in, but I bet you when we start to see the numbers of inflows into ETFs, this Friday, next Friday, you're going to see positive inflows. So, all in all, I'm very bullish on gold. And of course, the gold stocks, if gold is cheap relative to stocks, which it is, a month ago it was selling at 20-year lows relative to gold, and it remains low relative to stocks, sorry. So if gold is undervalued relative to stocks, gold stocks are even more undervalued relative to gold. On some metrics, we're trading at valuations very close to 10-year lows. Not quite to 10-year lows, but close to 10-year lows. So I don't know if I sound bullish, but I am.
Yeah, you do sound bullish, and it's hard not to, if you're paying close attention, see all the signs at this point in time that are pointing to a nice fall rally here. Adrian, gold should act as an insurance policy, and so, when you have a stock market crash or different tensions around the world, gold should pick up, but a lot of gold investors are jaded by what happened in 2008 when gold got taken down, at least initially, as well as the gold stocks. And the difference now is that gold and gold stocks aren't at a 7-year high. But do you have fear, and how do you protect yourself and your clients against the possibility of all equities selling off?
I think it's a valid fear, but I think you just raised a couple of issues. Typically, when you have a short, sharp decline in the market, everything will go down with it initially. When you have a slower decline, and it could be a long-lasting decline and a deep decline, but slower, then you tend to get rotation from expensive sectors such as the FANGs and the technology stocks into cheaper sectors such as the gold and resource stocks. That's the first point. Second point I would make is that 2008 was a credit crisis. And in a credit crisis, people look for liquidity. Gold was one of the most liquid assets in the world and was one of the first things people sold. After all, if you own gold as insurance, well, October of 2008 was exactly when you needed that insurance. And so, people sold liquid assets. That's the second point I'd make. But the third point I'd make is that both gold, and you touched on this, both gold and, in fact, gold stocks bounced back from 2008 a lot sooner than the broad market did. You saw gold stocks basically bottom in December. You saw the broad market bottom in March. So, yes, everything went down. Now, will that happen again? Well, if you look back, and the last factor, which is the most important factor of all, and you did mention it, I have done some work on this, and the most important factor determining whether gold stocks fall with the rest of the market in a decline is whether the gold stocks have already been in a bull market, are expensive. In other words, did they participate in the previous bull market? I think one would have to say that the stock market over the last 4 years, has gone up tremendously, and the gold stocks have not. The gold stocks have not really participated, nor are they expensive. So in that kind of scenario, I'm not saying in a market crash the gold stocks wouldn't go down initially, but they won't go down as much as the rest of the market, and they'll probably come back a lot sooner. So I wouldn't be overly concerned about that, frankly.
Adrian, if you rewind back to the beginning of this bull cycle or bull market, January of 2016, the gold stocks were historically cheap on a relative basis and an absolute basis. And that was at a time when the commodities as a whole were registering at historic lows against the S&P. Things are a little bit different now. Maybe we're in the second or third inning of this bull market, but how cheap do you feel the gold equities are at this moment in time?
Oh, I think they're let's say pretty cheap. They're not at their absolute lows, as you say, but they're certainly pretty cheap. If you look at, say, the XAU index, and the XAU index, as you know, is an imperfect index. It includes good companies along with a bunch of, well, let's say, companies I wouldn't own, but it is the leading index for the major gold and silver miners, primarily U.S. ones. And you can see that we've had 4 major bottoms over the last 25 years. And after each one of those, the XAU has at least doubled, and normally done more than that, and on one of those 4 occasions, tripled. So where we are now, as you said, the beginning of 2016 was the absolute low, but where we are now is much closer to that bottom than it is to that top. So I think, and by much, you'd have to look at a graph to see what I'm talking about, but it's about anywhere from a quarter off, a quarter to a third off the low to previous peaks, which means that we've got at least a double from here, in my view, at least a double.
You said something to me before the interview that I felt was key, and I've never heard it said quite that way before. I want you to explain it to our audience. You said, quote, "Don't confuse size with risk in the mining business."
Well, I think it's true in many sectors. A little anecdote I'll tell you. At the beginning of 2008, a client came to me and said their assets were being managed very conservatively by one of the major bank trust companies in the country. We only have large blue chips. And when I looked at it, I kid you not, they had Bank of America and Citibank. They had Fannie Mae and Freddie Mac. They had GM. I mean, basically, it was almost as though, in hindsight, someone had picked all of the stocks that were going to crash the worst in 2008. But size shouldn't be confused with conservatism, and particularly in the mining business, because mining is an extremely difficult business. So I think if we look at some of the big mining companies, we can point to some of the mistakes that some of these companies have made, and they have made mistakes. And the biggest mistake of all is not acting in a contra-cyclical manner. But, these companies were going out wildly, as a group, wildly overpaying for marginal assets in 2011 and 12, right at the top of the market. And yet in 2014 and 15, with few exceptions, they were backing off, they were paying down debt, they were, buying back their hedges, but very few were going out buying assets at the absolute bottom. So, the inherent difficulties of mining have been compounded by some poor management, and I'm painting with a very broad brush. Obviously, you can look at companies like Rand Gold with superb management, as he keeps telling us, but have acted very well, and other companies that have been pro-cyclical as opposed to anti-cyclical, fighting the cycles. Companies like Franco-Nevada, for example, have been very good at that. So painting with a broad brush, but it's a difficult business, and so even in the best of times with the best of management, these companies are going to be struggling, and they're going to constantly hit problems, whatever it is. Mines, problems at mines with water flooding a mine, or problems with governments demanding 51% of your asset that you've spent 10 years and $20 billion building, and so on and so forth. Smaller companies, exploration companies, for a lot of reasons, they tend to be under the radar, but they're not in the operational business. And so they don't fight those kind of challenges. They have other challenges, of course. But, big mining companies to me they're not investments. And you only have to look at the 20-year performance of stocks like Barrick and Newmont and I'm not picking on those two, but just the large ones, to see that, if you held them as an investment, you haven't really done very well. Whereas, you can hold a company like Nestle, and you can hold that for 20 years. And notice I'm not picking some technology company that happened to do well, when 20 others did badly. But Nestle, one of the largest food companies in the world, hold that for 20 years. And you have ups and downs, but you're still way ahead after 20 years. You look at Barrick or Newmont, and it's basically been dead money if you held it that long. So so we look at large cap companies more as trading situations. They frequently get knocked down badly on earnings misses. A company misses earnings by a penny and everybody freaks out and the stock collapses. And you can find, good values if you look for opportunities like that. We had a great one in New Gold recently, if you remember, when they had some bad news that, they told the market that they had enough cash to build a mine, and then they announced they didn't have enough cash to build a mine. Stock went from 330 down to, what is that, 260. That's a pretty good drop. And so you can take advantage of things like that, but they're trading vehicles in my mind.
Adrian, I want to wrap up with an individual company that I want to talk about in a small monologue here, if I may. Royalty and streaming companies performed exceptionally well relative to the majors and especially the juniors during the bear market. And for that reason, I don't have particular interest in investing in most royalty companies at this point in time, simply because I think there's more torque in something that's gone down a lot, an optionality play as an example. There's an exception to that in a company that we found and invested in, and I was delighted to find out that you in your group own over 10% of the company. Doug Casey, large shareholder, the head of Casey Research, E.B. Tucker, big shareholder. The company's Metalla Royalty and Streaming, and the symbol's MTA. I just want to get a sense of, from your perspective, why you like that company so much to establish such a high percentage ownership in it.
Sure. Well, first of all, let me just say I like the royalty model. You've mentioned that. I mean, I like the royalty model, and our largest holdings, frankly, remain Franco-Nevada, Royal Gold, and Osisko Royalties. Those three companies are our largest holdings. Now, I sort of agree with you that the valuations are a little rich at the moment, so we won't go into that. But these are great companies that have built, tremendous businesses. So. And I like the royalty business model, which for people who don't know it is essentially a low-risk way of investing in mining, because a royalty company typically makes an investment, either a producer, exploration company, development company, whatever, but they make an investment in return for a royalty on future production, and then they're not responsible for things that go wrong at the company. And things will go wrong with mines. Rest assured, things will go wrong. So, but the royalty company is not responsible. Now, why do I like Metalla? Well, you have to start with liking the model. You have to look at Metalla and say this is a 40 million market cap company compared with whatever $15 billion for Franco-Nevada. So it's new. One of the things that's impressed me tremendously about this company since Brett Heath, the president and CEO, took over not much more than a year ago, and the tremendous progress that he and the team have made in a short amount of time. They now have producing royalties, so they're going to be cash flow positive this year, coming 12 months from now. I mean, looking at the next 12 months, they'll be cash flow positive. They have a good portfolio. About 15 different royalties and streams. Some of them pretty small. Some of them won't come into production for a long time. But to build up that kind of asset base within a year has been pretty powerful in my mind. One of the things I like about the way the company conducts itself is typically they will look for royalty or stream that they want to buy, and then they will do an equity financing, typically, in order to raise the money to buy it. And that has two great benefits. One is it minimizes the dilution, which is a problem with so many small companies, as you know, constantly raising money and diluting shareholders. But the good thing about this is they only raise money when they have an asset, so it's not dilution. It's obviously share count dilution, but it's not dilution at the asset basis. And if Brett starts calling his major institutional shareholders and everybody says, you know what, I don't like this asset, Brett, I wouldn't buy it. Well, that's a great signal to the market. Maybe I should say it the other way around. If all of his institutional shareholders say, wow, that's a great asset, great price, I want in, that's validation of what the company's doing. So I like that a lot because let's face it, too many companies, when you give them money, they find a way of spending it. I like this model much better. Find the asset, find the thing you want to spend it on, and then see if your shareholders will give you the money to buy it. So anyway, so they've done a tremendous job in a short period of time with both producing assets and a good pipeline of developmental assets. Diversified assets in Africa, in Australia, and then the other thing is they're looking at starting a dividend program pretty soon. And of course, royalty companies are ideally suited for paying dividends, whereas mining companies, frankly, which are capital-intensive business, are not suited for paying dividends. And so that could be very, very attractive. I think this is extremely undervalued right now, frankly, and the market doesn't really realize, particularly the large royalties package they did from Core. I think the market is not royalty and stream. The market hasn't really recognized this company is still flying under the radar. You know, it was a $70 stock, earlier in the year, and last year it was at $1. And we're now trading at 50 cents with many, many, many more assets. I think this is a great buy right now.
Well, Adrian, I think that the mantra of management's used to exhaustion, but it's very true in the business, and Brett is a superstar on the deals he's been getting done here, so I think that if that continues, this company is going to surprise with more deals and market appreciation. I know that we're well over time here and you have to get on to your next call, so I want to thank you for coming on the program and speaking to our listeners today. And definitely
thank you.
Yeah, absolutely. And would love to get you back here in the next couple months.
Yeah, no, whenever's good for you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?